Imagine you walk into a giant building where people are screaming at each other, waving pieces of paper, and somehow making millions of dollars disappear and reappear every few seconds. Welcome to the stock market, the world's most expensive casino, where everyone thinks they're Warren Buffett until they're not. Here's what's wild: every single day, over $500 billion changes hands in the US stock market alone. That's more money than most countries see in a year. And it all happens because people are basically trading ownership slices of companies like they're Pokemon cards. But here's the thing, nobody tells you when you're starting out, the stock market isn't actually about stocks. It's about human psychology, mass hysteria, and the bizarre ways people react when money is involved. And by the end of this video, you'll understand exactly how this beautiful disaster works, why it makes people rich and poor simultaneously, and most importantly, why a bunch of very smart people sometimes make very dumb decisions with other people's money. Let's start with the most basic question. What exactly is a stock picture? This you and 3 friends decide to buy a pizza together. The pizza costs $20, so you each pay $5. Congratulations, you now own 25% of a pizza. That slice is yours. You can eat it, save it, or even sell your 25% ownership to someone else if they're willing to pay for it. A stock works exactly the same way, except instead of pizza, you're buying tiny pieces of entire companies. When Apple sells shares of stock, they're essentially saying, hey, we're going to slice our entire company into billions of pieces, and you can buy however many slices you want. Let's say Apple has 16 billion shares outstanding. If you buy 1,000 shares, you literally own 0.0000625% of Apple. You own a microscopic piece of every iPhone factory, every Apple store, every patent, and technically a few atoms of Tim Cook's turtleneck collection. Now here's where it gets interesting. You bought those 1,000 Apple shares because you think Apple will make more money in the future. Maybe they'll invent the iPhone 47, or maybe they'll figure out how to make AirPods that don't fall out of your ears. Either way, if Apple makes more money, your slice of the company becomes more valuable. But here's the catch, and this is where things get psychologically weird. The price of your Apple stock doesn't just depend on how much money Apple actually makes. It depends on how much money other people think Apple will make, and how much those people are willing to pay for your shares right now. This is where we enter the realm of collective madness that makes the stock market so beautifully unpredictable. The stock market isn't a store with fixed prices, it's more like a 24/7 auction house where millions of people are simultaneously bidding on company slices, and the prices change every single second based on who wants to buy and who wants to sell. Let's break this down with a simple example. Imagine there are exactly 10 shares of McDonald's stock in existence. 5 people want to buy McDonald's shares, and they're willing to pay $100, $105, $110, $115, and $120 respectively. Meanwhile, 5 current McDonald's shareholders want to sell, but only for $125, $130, $135, $140, and $145. Here's the problem. The highest buyer, $120, and the lowest seller, $125, are $5 apart. No trade happens until someone budges. Maybe the buyer gets impatient and offers $125, or maybe the seller gets nervous and accepts $120. The moment they agree, boom, that becomes the new stock price of McDonald's. Now multiply this by millions of buyers and sellers trading millions of shares every single second the market is open. The price is constantly fluctuating based on this endless tug-of-war between people who want to buy and people who want to sell. But here's where human psychology makes everything insane. These buying and selling decisions aren't based purely on rational analysis of McDonald's hamburger making capabilities. They're based on emotions, rumors, gut feelings, what someone's brother-in-law said at a barbecue, and sometimes pure panic. In 2020, Zoom's stock price went from $68 to $588 in 8 months. Not because Zoom suddenly became 8.6 times better at video calls, but because millions of people suddenly realized they needed to video call their grandparents and couldn't figure out how their laptop cameras worked. The stock market, in essence, is humanity's attempt to put a price tag on the future. And humanity, as we'll see, is really, really bad at predicting the future. You can't just walk up to Tim Cook and say, "Hey, I'll give you $150 for some Apple stock." There's an entire infrastructure of middlemen who make stock trading possible, and they all take their cut along the way. First, you need a broker. Think of brokers as the bouncer at the stock market nightclub. You give them your money, tell them what you want to buy, and they go into the market and execute your trade. Companies like Fidelity, Charles Schwab, and Robinhood are brokers. They used to charge $7 to $10 per trade, but now most trades are free, and we'll talk about why free is in quotes in a moment. Then you have the stock exchanges, the actual venues where trading happens. The New York Stock Exchange and NASDAQ are the big ones in America. These are like giant electronic matching systems that pair up buyers and sellers millions of times per day. But here's where it gets weird. Most of your trades don't actually happen on these exchanges anymore. They happen in something called dark pools, private trading venues run by big banks and investment firms. About 40% of all stock trades now happen in dark pools away from public view. Why does this matter? Well, remember how Robinhood offers free trading. They make money by selling information about your trades to high-frequency trading firms before your trades actually execute. These firms use super fast computers to trade against you, making tiny profits on millions of trades. It's called payment for order flow, and it's basically Robinhood selling you out to make money. Your free trade costs you a few cents in worse execution, and Robinhood pockets the difference. The entire system is designed to extract tiny amounts of money from every transaction. You're not just buying stocks, you're feeding a massive ecosystem of middlemen who all need to get paid. And this is all before we get to the really fun stuff, derivatives. Buying stocks is like buying a car. You pay the full price upfront, you own the car, and whatever happens to the car's value happens to your money. Simple enough. But the financial industry looked at this and thought, what if we made this way more complicated and potentially catastrophic? Enter derivatives, financial instruments that derive their value from other financial instruments. It's like betting on bets. Let's start with stock options. Instead of buying 100 shares of Tesla for $25,000, you can buy the option to purchase those shares at a specific price within a specific time frame. Maybe you pay $500 for the right to buy Tesla at $250 per share anytime in the next 3 months. If Tesla goes to $300, you can exercise your option, buy the shares for $250, and immediately sell them for $300. You just made $5,000 on a $500 investment, but if Tesla drops to $200, your option expires worthless. You're out the entire $500. Options turn the stock market into a casino with a time limit. People aren't just betting on whether a stock will go up or down, they're betting on whether it will go up or down by a specific amount within a specific time frame. The psychological pressure is intense, and it makes people do incredibly stupid things with money they can't afford to lose. Then we have futures contracts where you agree to buy or sell something at a specific price on a specific future date. Farmers use futures to lock in prices for their crops, but speculators use futures to bet on everything from oil prices to interest rates to Bitcoin. The derivatives market is estimated to be worth over $1 quadrillion globally. That's $1,000 trillion. To put that in perspective, the entire world economy is about $100 trillion. We've created a financial betting system that's 10 times bigger than the actual economy it's supposed to be based on. Warren Buffett called derivatives financial weapons of mass destruction. And he wasn't being dramatic. In 2008, derivatives tied to housing mortgages nearly destroyed the global financial system. But we'll get to that disaster in a moment. Every few years, the stock market collectively loses its mind. Rational, intelligent people start paying absurd prices for stocks based on pure speculation, and everyone seems to forget that prices can go down as well as up. The pattern is always the same. First, there's a new technology or trend that genuinely seems promising. The internet in the 1990s, housing in the 2000s, social media companies in the 2010s, electric vehicles, and AI in the 2020s. Then, early investors start making a lot of money and word spreads. More people pile in, driving prices higher. The higher prices attract even more people, creating a feedback loop. Soon, you have your grandmother asking how to buy Dogecoin and teenagers taking out loans to buy GameStop options. The dot-com bubble is a perfect example. In the late 1990s, any company that added .com to its name saw its stock price skyrocket. Pets.com, which sold pet supplies online, went public with a valuation of $290 million, despite losing money on every single sale. The company spent $11, $8 million on Super Bowl ads, and went bankrupt 9 months later. But here's the psychological twist. Even when people know they're in a bubble, they can't help themselves. They think they'll be smart enough to get out before it pops. It's like musical chairs, except everyone thinks they have faster reflexes than everyone else. The bubble always pops eventually, because bubbles are built on expectations rather than reality. When expectations finally collide with actual business, fundamentals prices collapse. The NASDAQ lost 78% of its value between 2000 and 2002. Entire retirement accounts disappeared overnight. But here's what's really wild: after every crash, we collectively forget what just happened and create the next bubble. In 2008, it was mortgage-backed securities. In 2021, it was meme stocks and SPACs. Right now, it might be AI stocks. The stock market isn't just a wealth creation machine, it's also a wealth destruction machine that operates on a fairly predictable cycle of greed, fear, and amnesia. Remember those screaming traders from the beginning? Most of them don't exist anymore. Today, about 70% of all stock trades are executed by algorithms, computer programs, that can analyze market data and execute trades in microseconds. High-frequency trading firms have servers located as close as possible to stock exchange servers because even a 1 millisecond advantage can be worth millions of dollars. They've literally moved mountains to shorten the cable length between Chicago and New York by 3 milliseconds. 3 milliseconds faster than you can blink is worth billions in trading profits. These algorithms don't care about company fundamentals or future prospects. They're looking for tiny price discrepancies they can exploit thousands of times per second. They're trading against your retirement account using strategies you couldn't understand if you had a PhD in mathematics. But here's where it gets really weird. Sometimes the algorithms start trading against each other in feedback loops that create massive market swings for no reason whatsoever. On May 6, 2010, the Dow Jones dropped nearly 1,000 points in minutes because algorithms started panic selling to other algorithms. It's called a flash crash. And it happens when computers get confused and start selling everything to other confused computers. In 2018, the VIX, a measure of market fear, spiked 116% in a single day, triggering algorithmic selling that wiped out $5 trillion in global market value. The cause: a few volatility traders got nervous about rising interest rates, which triggered computer algorithms that triggered more computer algorithms, creating a cascading panic that lasted exactly long enough for humans to realize the computers had lost their minds. Your stock portfolio is now subject to the emotional stability of computer programs designed by people who've never actually bought a stock for their retirement account. The market has become part casino, part video game, and part science experiment gone wrong. And yet somehow, this chaotic system still manages to function as a mechanism for funding business growth and creating long-term wealth. Despite all the bubbles, crashes, algorithms, and general insanity, the stock market has generated positive returns over the long term. The S&P 500 has averaged about 10% annual returns over the past century, including the Great Depression, multiple world wars, and various financial crises. Here's why this seemingly broken system actually works. Underneath all the speculation and algorithmic trading, the stock market is still fundamentally connected to business profits. Companies that make more money tend to have higher stock prices over time. Companies that lose money tend to go bankrupt, and their stock prices go to zero. The market is incredibly efficient at pricing in new information. When Apple announces better than expected iPhone sales, the stock price adjusts within seconds. When a pharmaceutical company's drug trial fails, the stock drops immediately. Millions of investors are constantly analyzing every piece of available information and betting money on their conclusions. This creates what economists call price discovery, the market's collective wisdom about what companies are actually worth. Sure, this wisdom gets drunk on speculation every few years, but over long periods, it's remarkably accurate. More importantly, the stock market provides a mechanism for companies to raise money for growth. When Amazon went public in 1997, it raised $54 million that allowed it to expand from books to becoming the everything store. When Tesla went public in 2010, it raised $226 million that funded the development of electric vehicles that are now changing the entire automotive industry. Individual investors can participate in this wealth creation by owning diversified portfolios of stocks. You don't need to pick individual winners. You can buy index funds that own tiny pieces of hundreds or thousands of companies. Over time, as these companies grow and become more profitable, your investment grows with them. The key is ignoring the daily noise and focusing on the long-term trend. Human ingenuity tends to create value over time, and owning shares of businesses allows you to participate in that value creation. And here, we arrive at the fundamental paradox of the stock market. It's simultaneously completely irrational and surprisingly logical, totally unpredictable, and remarkably consistent, a wealth destruction machine and the greatest wealth creation mechanism in human history. The stock market works because it harnesses human greed, fear, and optimism in service of capital allocation. When investors think a company will be profitable, they bid up its stock price, giving that company access to cheap capital for expansion. When investors think a company is doomed, they sell, making it harder for that company to raise money. It's democracy applied to business funding. But the system only works because most participants don't understand how it works. If everyone were perfectly rational, there would be no opportunities for profit, no bubbles to pop, and no crashes to recover from. The market needs irrational exuberance and panic selling to function. Individual investors make emotional decisions, buying high when everyone's excited and selling low when everyone's scared. But these emotional decisions create opportunities for disciplined, long-term investors who can ignore the noise and focus on business fundamentals. The algorithms and high-frequency traders add liquidity and efficiency, but they can't change the underlying reality that profitable companies tend to have rising stock prices over time, and unprofitable companies tend to disappear. The derivatives and options create leverage and risk, but they also allow for sophisticated hedging strategies that can reduce overall portfolio risk when used properly. Even the bubbles serve a purpose. They channel massive amounts of capital toward new technologies and business models. Yes, most .com companies went bankrupt, but the internet infrastructure built during the bubble enabled Amazon, Google, and Facebook to flourish. Yes, most AI startups will probably fail, but the capital flowing into artificial intelligence research today might create the technologies that define the next century. So there you have it. The stock market explained, like you're 5, except you're probably not 5 anymore by the time you understand all this. The stock market is humanity's attempt to put price tags on the future, and humanity is terrible at predicting the future, but surprisingly good at creating value over time. It's a system built on collective delusion that somehow produces collective wealth. Every day, millions of people make bets on pieces of paper representing ownership in companies they've never visited, making products they don't understand for customers they've never met. And somehow, this elaborate fiction has created more wealth than any economic system in human history. The craziest part, you can participate in this beautiful madness by simply buying a diversified index fund and waiting 20 years. While everyone else is trying to time the market pick winners and outsmart the algorithms, you can just own a tiny piece of human economic progress and let compound returns do the work. The stock market where logic goes to die, fortunes go to multiply, and 5-year-olds probably have better investment strategies than most adults. Because sometimes the best way to win a complicated game is to not play it at all, just bet on the house.